Economic disparity. Wall Street's heat, Main Street's chill. At the peak of the COVID-19 crisis, the Federal Reserve and the U.S. government enacted policies to stabilize the financial markets. While these measures led to a rapid rebound of the stock market, the real economy lagged behind, creating a stark contrast between Wall Street's buoyancy and Main Street's struggles. Despite widespread unemployment and economic stagnation, the stock market surged, driven by the optimism for the tech-dominated Nasdaq and the Federal Reserve's low interest rates and quantitative easing. This situation highlighted a growing disconnect between the financial markets and the real economic conditions. The booming stock market was partly due to the fear of missing out (FOMO) phenomenon, as investors, particularly younger individuals using platforms like Robinhood, rushed to buy stocks, fearing they might miss the upward trend. Stocks of large IT companies, notably the FAANG Group, were particularly attractive, seen as resilient and benefiting from the shift to digital and remote working. The concentration of market capitalization in these few companies raised concerns about market health and sustainability. Despite the rapid market recovery, there were worries about potential overvaluation. The price-to-earnings ratio of stocks significantly increased, indicating that stocks might be overpriced relative to their earnings. This surge in stock prices occurred despite the significant decrease in company profits due to the pandemic, suggesting a disconnection from the real economy's health. Investors' optimism was fueled by the long-term economic prospects rather than current economic downturns. The stock market often reacts to future expectations, and despite the immediate impact of COVID-19, there was a prevailing belief that the economy would bounce back, particularly given the nature of the crisis as an external shock rather than a systemic economic failure. This belief was supported by early signs of recovery, developments in COVID-19 treatments, and vaccine progress, as well as the gradual lifting of lockdowns and the anticipation of pent-up demand. However, the discrepancy between the thriving stock market and the struggling real economy underscored the complex and often disconnected relationship between financial market dynamics and broader economic health. The record boom in the bond market. The bond market experienced a record boom due to unprecedented liquidity, leading to historically low market interest rates, especially for 10-year U.S. Treasury bonds, which reached a low of 0.52% in August 2020. This low yield was part of a broader trend initiated by risk-off trades during the pandemic's onset, with investors flocking to safe assets like government bonds. The enduring low rates were sustained by investor confidence in the Federal Reserve's commitment to maintaining zero interest rates and quantitative easing. Anticipating policies like negative interest rates or yield curve control, investors increasingly bought government bonds. After the 2008 financial crisis, banks were holding a high proportion of safe assets, but the COVID-19 uncertainty initially deterred lending. However, the Federal Reserve's special lending programs and other measures encouraged banks to resume lending, contributing to the low market interest rates and favorable borrowing conditions. Bond prices rebounded, supported by the Federal Reserve's interventions, leading investors to buy bonds in anticipation of further price increases. The increased liquidity also spilled over into the corporate bond market, with a surge in issuance of both investment-grade and high-yield bonds following the Fed's announcement of support plans for select high-yield bonds. Companies took advantage of the low interest rates to refinance existing debts and build cash reserves, leading to the largest ever recorded corporate bond issuance in 2020. However, this trend did not lead to a substantial increase in corporate investments, as many companies were building cash reserves in anticipation of continuing economic uncertainty.